the $1 Million Mortgage Experience podcast. All right, welcome to the show. We are in the new studio here. This is the $1 Million Mortgage Experience podcast, and we're here with Chad Mestler. He's the CEO of Helvetica Group. They are a real estate investment bank and family office. He's also an attorney, and during the financial crisis, he did thousands of transactions, buying tapes of distressed assets and things like that. Now he's pioneering a lending blockchain strategy, which I'm excited, and we'll dive into that. So welcome to the show.
Thanks for having me.
Yeah, man, stoked to be in this new spot and to finally get you in here.
Yeah.
So
any excuse to talk about myself and drink tequila.
Absolutely. Well, yeah, let's start out with just kind of like what's going on with your business and like what are you guys focused on?
I mean, we're focused, I guess it depends on the market. Right now, the market, it's a bit challenging. There's a lot of, everybody's kind of skeptical of what's going to happen in the future. So I think we're cautious, but still looking at the same asset classes. We're still lending money. We're not buying assets right now. Of course, blind squirrel finds a nut every once in a while. So
yeah, like if you find some deals.
Yeah. But it's, everybody's kind of wondering, where the market's going to land. So we're all expecting a pullback.
Yep.
So, if we're going to buy any assets, it would have to be very discounted, right? Or a big value add component. So yeah, on the real estate side, we're still lending. We're cautious. We still look for assets. Again, cautious. But we're waiting. We're waiting for distress.
You're doing some mixed use and commercial properties. Is that like what you typically lend on? If that's your
I guess at the core, we're a bridge lender, so we loan nationwide on basic food groups. Commercial. So light industrial, office, multifamily, retail. We love retail. We do retail centers. We buy triple net deals. We occasionally buy value add stuff like land. We're not a land buyer, but we just bought some land right in Reno because we're big fans of Reno.
There's some stuff happening in Reno,
yeah. Yeah, Reno's on fire. Reno's used to be gaming, mining, prostitution. Now it's basically all the industry is there. You've got this area called Tahoe Reno Industrial Center, which is where you find the Tesla Gigafactory.
Yep.
And then it's not just Tesla. Tesla's like the big PR piece, but you got PetSmart, FedEx, distributions. Apple, Google. Everybody's in that market now.
There's been like a big migration from California, right, to get away from the taxes, or partly.
Yeah. Well, so there's a lot of job growth in Reno. If you go and talk to EDON, that's their economic development for Reno.
Yep.
They had like a shortage of like 30,000 homes. So the builders, they weren't building a lot because of the last financial crisis. I think everybody got a little cautious. Yep. So they're building small subdivisions instead of big ones. And then, there is a lot of migration. So people, even before COVID, people were moving over the hill to, get into a friendlier business climate, less taxes, nice quality of life.
Right.
And then of course, all the businesses that were moving there because of that whole trick area, they were bringing people with them also.
Yep.
And then you have COVID, and then everybody's like, okay, now we're remote, right? And I don't really want to be in the city. So a lot more migration was happening into Reno. So it's booming.
That's cool. Yeah. So you got some land near there and do some value add stuff.
Yeah. So we bought 39 lots. They're in a luxury community called Montreux. It's a golf course community. They got big clubhouse. The homes are 2 to 13 million plus.
Jeez.
Jack Nicklaus Golf Course. It's nice. It's a really nice community.
That's great, man. So you've been through a couple cycles in the biz. You've been in the biz for quite a while. You've lived overseas in Switzerland and seen a thing or two. And now, we were just talking offline a little bit about what's going on in the market right now today. And you just got back from a conference. People are, there's some uncertainty. Share with us a little bit of your thoughts on, kind of, I know it's different. We probably would agree today is different than 2008 in a lot of different ways, but there's also definitely distress in some areas. So like, what are you seeing? How do you compare it to, '08 or other crises? I know you talked about the .com bubble. Just share with us kind of like what you're seeing in the economy now.
Well, I mean, just recently, obviously, we printed a lot of money, right? So we had COVID,
Trillions.
and then it was a lot of money. So as a result, the result is inflation, and now we have the Fed is starting to curb that inflation, right? So they're pumping the brakes. But that's causing, rates to go up quickly, and rates going up quickly, it's creating uncertainty in the market, right? So we're seeing, just the last conference, for instance, it seems like a lot of the securitizations have shut down. So a lot of products that were in vogue the last couple of years, like the, debt service coverage, those rental loans.
Yep, DSCR.
Yeah, those, they went from 4% to 9%.
Yeah. Overnight, practically.
Yep. Fix and flip, same thing. So, a lot of the rates have gone up in these asset classes that were really popular. And, obviously when rates go up, the return on investment goes down. So people are, they're not buying as much. Yep. And certainly when liquidity goes down, then you have less demand. And when you have less demand, then you have, basically it affects pricing. And so all that, I think we're starting to feel all that right now. And so you're seeing a little bit in the news about, well, prices are starting to come down, but sellers are kind of waiting, sort of. I think they're, there's always this lag that, sellers are, going to kind of wait to see what the prices are from everybody else, but it's happening.
Yeah.
So.
I was thinking, sellers, the difference in my mind of what's happening is the sellers now are thinking more like, let me see if I can get a certain price. Whereas like in '08, they had to sell because the adjustments were happening. Remember the 228s and the 327 loans, and all of a sudden their loan came from a fixed to an adjustable, went up 2%, went up 3%. And so they were in this position, and they also had a lot of high LTVs. So they were like underwater. Where now, maybe a seller has 40% equity in the home, and they don't have an adjustable. They have a low fixed rate. So they're like, let me see if I can get this high price. And if I can't, maybe I just will wait and rent it out or something like that, right? Like that's kind of where my mind's been, and like why I don't think it's going to be as big of a crisis as '08. '08, you had a lot of distress, like a lot of people that were like, shit, I shouldn't have bought. I do see that there's some regrets out there of people buying. Maybe they think they bought the top of the market, and so they're like, oh crap, maybe I need to sell. What did I do? Got into the market. It was crazy. I didn't even see the place. I made an offer. There's 14 other offers, and it was just, so I know that like there are a lot of people waiting for this doom and gloom to happen, but how certain is that? Like, or is it just nobody knows?
Yeah, I mean, everybody has a different crystal ball. And I agree. I think there's a lot more equity because we did have such massive inflation, and the inflation is going to continue, right? Because we have to digest all the money that we just printed. And what's the net effect of all these different anecdotes, right? I think there are definitely anecdotes of people that have a lot of equity and don't need to sell, and certainly when they're sitting on a 3% mortgage, probably not going to want to sell, right? Even though maybe they want to move, but it's going to be kind of a tough decision, to jump
maybe
into
keep it rented out and then buy another, place or something.
Yeah. So I think there's definitely that anecdote, right? Those people. There's also the people. So I was talking to a special servicer, a couple servicers, at this conference as an example, right? One servicer had, they're doing about $5 billion worth of servicing. And, one of his thoughts was, and what he's seen is that because of the inflation, you have, property taxes are going up, insurance is going up. So
gas and electric's going up, water.
Yeah. So now you have affordability issues with a lot of people. Now, I haven't done the math on that. I don't know what that means statistically or demographically or how many of those people are out there. But that's going to cause distress where people, maybe they do have a lot of equity, but everything's going up on them.
Yep.
Right. So it's definitely different. And it's actually something we haven't seen in our lifetime. Printing this much money and how that trickles into the economy, how it creates inflation, how it creates affordability issues, and what that does, what the net effect of that is. So we're going to watch it happen over the next 12 months for sure.
Get the popcorn out and tequila out.
Yeah.
So where would you put your money right now? Like, or where are you putting your money in? I mean, a lot of people are sitting on the sidelines. Like, even we were talking earlier about the bond market, right? A lot of these guys are just like, I don't want to buy these AAAs, or they're just sort of sitting waiting. You know, the government's backing down on buying bonds as well, you know, mortgage bonds. So there's a lot of people just sort of like sitting on cash, which is terrible to do in an inflationary environment, right? But then you're like, well, I don't know where to put it. So do you have any insight to where's a good place to? I mean, Bitcoin's low, right? Everything's kind of shaking up.
Yeah, I mean, gold, ammo, and canned goods maybe is a good place to start.
I always thought cigarettes were a good.
Yeah, so all the
apocalyptic buy.
Yeah, what are they called? The vice, right? The vice investments. You know, so I think gold is an interesting thing to look at. You know, I've been watching a lot of things on gold, right? Like, I mean, the government manipulates gold. It has since we got off the gold. So there's a point in time when they might not be able to keep the lid on that, especially if we just printed so much money, right? And gold hasn't really gone.
I watched that and I'm like, how is gold not gone way up?
Right.
But you say the government sort of keeps a
subsidy. They have you know, they're buying and selling. They're big in that market, and so there's some really interesting videos and books on the history of gold and monetary policy. Yeah. So I mean, I think gold is one place to put your money.
Are you thinking like coins or like bars, whatever you can afford?
You know, Kugrans are cool, but you know, there's also, I mean, talking about crypto, there's a couple crypto-backed stable coin or gold-backed stable coins. You know, ones Pax Gold is one. Actually, Sheila Blair is on the board of directors for that. You know, if that gives any confidence in a stable coin, right? Because stable coins are, you know, they can be challenging if they're not audited properly, right? Like Tether. You know, people are still wondering whether Tether has enough, you know, cash, U.S. dollars to back what they're promising. But you know, like a Pax Gold is kind of interesting. You know, opportunity to own gold without actually physically owning the gold.
That's interesting. Yeah, I haven't seen those coins. Are they on like Coinbase or?
I think they're on Coinbase. Like a
stable coin.
Yeah, they're on a couple of the the exchanges. Yeah.
Interesting, because that might be something, to put your money in.
Yeah, I mean, it's just diversifying, right? Yeah, buy Kugrans, you know.
Right.
Yeah, you know, Pax Gold. Every coin is backed by an ounce of gold, basically.
Got it.
Pax Gold. So gold's an interesting one. You know, what other inflationary, you know, commodities?
Yeah.
You know, I saw, you know, there's one guy had a perspective, which is, you know, we're going to see some, you know, major pullback in all financial assets, right? But commodities and consumer prices are going to go up, you know.
Yeah, like corn. Different like oil, people trade oil, right?
Yeah, and then, you know, there's some rhetoric about the, you know, food shortages, and I mean, not to be doom destruction, but you know, just getting ready.
Have a little garden, can't hurt, right?
Right, yeah. Right, yeah, a little garden, you know, it's diversification.
Yeah, we started a little garden, and it's kind of nice. I'll like as I'm leaving the off like to go to the office, and I'll walk by and grab a couple strawberries and a little orange tree. Yeah, it can't hurt, right?
Yeah, right.
So one of the reasons why I really wanted to bring you on today was I know you're doing a lot of stuff in the blockchain. You're at the forefront of that more than, you know, we all know about it. We all know about Bitcoin. We all know about some other coins, but like that kind of all leads up to really what it sits on, which is a platform, and you know, this revolutionary idea that it's decentralized, and that current you know, it could be a currency. Countries are adopting Bitcoin and coins. Probably the U.S. and Europe will eventually adopt some type of, you know, what they call them, CDCs or
CDBCs, yeah, central bank digital currencies, yeah.
Yeah. So let's just talk a little bit about that, like how you think that'll affect lending. I know it affects title. Like you can really easily do it with title insurance. Kind of maybe even do away with title insurance with it, right? Like what are your areas of kind of exploring right now with that?
Well, I mean, I'm a believer that pretty much everything is going to be on blockchain eventually, you know, right? You know, but how do I unpack what you just asked?
That's a big question.
Yeah, right. There's a lot in there.
We can start with just like start with like what you're doing with it, like with your platform.
So, some of the low hanging fruit for blockchain is, you know, like digital securities. You know, and so what we're doing is, and it's just basically getting rid of the pain points and other things that are otherwise, painful to do, right? A lot of paper-based transactions, right? And so blockchain provides an opportunity to automate things, to digitize things, and also to create immutability and transparency and ownership. Because what blockchain is, right? It's a distributed ledger, so it's tamper-proof, right? If set up properly. So what we've done is we've set up. We basically took our offline business, which in the lending business. So what we do is fractional loans. So we have private investors and funds that invest in our loans, where it used to be paper, right? We send people PPMs, we send people notes, and they sign them, and subscription docs, and and then it's like herding cats, right? Okay, you got to get a check, you got to get a wire, right? You got to get the then DocuSign kind of created some degree of efficiencies, right? But it's still it's herding cats. People have to write their checks, they have to go to the mail, they have to go to FedEx, right? Or they have to go to the bank to wire money. So all those things are ripe for disruption because of blockchain. And so what we built is an online platform that allows our investors to invest in fractional pieces of commercial loans, and they don't have to get out of their seat, right? They can just do it on the computer. They can move their money, right? They can move their money by an ACH transaction,
and know it's secure, and like they're not. And they're buying a percentage of a building or of a note. Yeah. So for instance, just for easy math, right? It's a $5 million loan, and then we have 50 investors at 100,000. Right. So they all go online. They set up an account. They sign some subscription. They can review the project. There's a document vault. They can look at all those documents, and they can make an informed decision on whether or not they want to participate. And then there's a buy button. Right? There's a buy button, there's an add funds button, and then they go through the process, click, click, click. It's depending on how fast your fingers go. It's a minute, it's 2 minutes. And then you own a piece of real estate.
And you own a fractional piece of a loan, and then that is recorded on blockchain. Your ownership is recorded on blockchain. The documents are recorded on blockchain. And then the payments come in. There's their third-party servicer. It sends money to the platform. All the payments are recorded on blockchain. And then those payments go into your account, and then you can move the money out or you can reinvest. So it's the beginning, and then there's all kinds of other things you can do with blockchain over time. But I think that's kind of the pain point that's solved. Cool. the easiest thing, the lowest hanging fruit for blockchain to solve the pain point.
And what are the next steps that you think you'll add to blockchain? Because it shows that you're the owner. It proves that you're the owner. Mm-hmm. And is there anything with NFTs or anything like that? What's the next step? Tokenization
is the next step. So these notes could be tokenized, and then they can be traded on another exchange. So that's a next step. These are things that'll happen over time. For us, at the end of the day, our investors are not demanding it. If we start talking about cryptocurrency or blockchain, that they might actually get scared about those right? When it's actually for their benefit, but I don't think they really care so much, right? But the institutions are starting to demand it, right? If you go up the food chain to Wall Street is now starting to demand blockchain and the promises of blockchain, right? The immutability and the transparency of it all, right? And so they're actually starting to look at valuing their assets more often, right? So in the REITs and in the securitizations, it's difficult to get valuations on properties on a regular basis, right? But now, in partnership with some of the large, appraisal companies, they're starting to look at how they can update the values of these assets on a more regular basis, and then also record it on blockchain. Got it. Right. So now what you've done is you take an asset that's generally illiquid, which they call in GAAP accounting, it's like a level 3 asset, and they can move it up and make it a level 2 asset. It's not quite cash, right?
But if you could trade like a tokenization of it, or you could trade on a secondary market, you could make it liquid, or at least you could get access to quicker funds. Is that what?
Well, I think what happens is now, because the valuations are more regular, and they're more transparent, and and the users of the system and the people that are trading can see that more often, then your tokens become more liquid and more tradable, right? Because if you're buying a token, how do you know how much that asset is worth
at that given time?
On the origination or on the purchase, but you don't know at the time you're trading, so it makes it less liquid.
Yep.
Right.
So you get real-time data.
Yeah, more regular updates on the valuations, and now these things become more liquid, and as a result, you would hope that, cost of capital comes down, right? And it's, it's good for everybody, right?
That's
All
cool.
ships rise with the tide.
Right. Absolutely. Are you seeing what areas of disruption are happening with blockchain and lending?
Well, yeah, I mean, basically what we're doing on our platform, right? That's one form of disruption, right? It's, I mean, you take the private money industry. I mean, that's like ripe for disruption, right? It's very,
It's so
very old school. Yeah.
Yeah, like they, get your big book out and they
Yeah.
made their payment in the ledger, right?
Yeah, right. I mean, that's so. I think because that's where I swim. I swim in the private money sector, right?
Right.
I think that's one of the biggest opportunities for disruption. But if you move just into your traditional markets, right? You can see that all the stocks on NASDAQ, New York Stock Exchange, those will all get tokenized. It's just,
Really?
it's the best.
Like every stock in Facebook
Yeah.
or, whatever.
Right.
Home
All
Depot.
tokenized. They should all be on, they will eventually all be on blockchain.
Yeah.
Question which one. And the reason is because now what's going to happen is now all these stocks have a relative value to each other. You don't have to sell GM in order to buy Apple, right? You could actually trade GM straight for Apple.
Interesting.
So you get rid of a lot of friction. You get a lot of costs.
Fees too, yeah.
Less fees. And now, paint a picture. You have your crypto wallets. Crypto wallets now that can carry, hundreds of crypto, right?
Yeah.
So now you have a crypto wallet that carries tons of crypto. It's carrying also all your stocks. So you can envision a future where you actually don't even need a dollar, right? Because you're holding all your value, right, in your cryptocurrency. So you can go to Starbucks and go, I'm going to pay with a Tesla token, and Starbucks is going to accept it.
Of one, yeah.
Yeah, and then Starbucks is going to accept it because their point of sale system is going to go, will automatically convert it to whatever their store of value is, whatever they want, right? So why do we even need a dollar?
Yeah.
Now comes the question, right?
Do you want a dollar?
Do you want a dollar? And then whether or not central banks are going to allow you to do that, right? Because now
they're
they
gonna
lose.
say only cash is criminal stuff, right? Like
Yeah.
cash is not. If you're an ordinary person, you don't need cash. Like, especially if you could have it decentralized in a little wallet. Like I think it was El Salvador that just adopted this because a lot of people can't really go and open bank accounts. I mean, I don't know. I'm guessing this
The
is
unbanked. That's the big benefit.
Unbanked.
Yeah.
And so instead, everyone has a phone,
Right.
And they can easily just put it in. They have an email.
Right.
You need a phone and email, and then somehow you need a way to get that money in, or you just need to attach your job or whatever, and if they can pay you in that format.
Yep.
But interesting, yeah.
Yeah. Well, in El Salvador, right, they prior to Bitcoin, right, Nayib president. I mean, he's going to either be the smartest man alive or the craziest man alive, right? So, that existed during this time, right? Because he basically is all in Bitcoin,
Yeah.
And, one of the things is you want to get off the U.S. dollar, right? Because they're completely reliant on what the U.S. does.
If you go to El Salvador, do you use a U.S. dollar?
Yeah, so I was just there recently, actually, and they're still taking dollars, right? So I was in the airport. I didn't cruise around El Salvador, right? We stopped there on our way to Nicaragua.
Yeah.
But I was very interested to go and see if I could spend my Bitcoins, right?
Yeah.
But interesting enough, at the airport, nobody was taking Bitcoin. But I think, it's still, I think it's being adopted in those places where there's need.
Yeah.
Right. So like in those far out places in El Salvador where they're unbanked. Right. And so they solved a problem for, I think it was like Surf City, Bitcoin City, I think they called it, right? So this is where it started. And I think we're, kind of the genesis of why El Salvador adopted it and the president adopted it. It's because it solved a problem for these people in these little communities that didn't have money or a bank, no credit card. I mean, they didn't have banks, so they couldn't do credit card, right? So somebody went down there and implemented Bitcoin, and now they're trading and selling their wares with Bitcoin. So pretty interesting.
That's interesting. Do you think that the wallet itself will at some point become like a locker for all your financial information? I've been hearing that there's companies out there making lockers, and where like you put it's your W-2s, it's your pay stubs, it's your bank account, all your financial assets like your PFS, right? Your personal financial statement. Everything's in this wallet, so that if you want to get a loan, a car loan, anywhere, you just give them a key to your wallet and they can check it all. verify everything within
Yeah.
seconds, and then you can make these transactions happen very quickly.
Yeah.
Like you could probably get it. Fast forward 10 years from now, I think you probably could get a home loan within minutes if you have it all in a wallet.
Right.
All your information, your insurance, everything's all. So
Digital identity.
yeah, it's like your digital identity.
Yeah. And there's some interesting things that are happening with banking, right? If you talk to somebody, if you go to some of these blockchain conferences, it's interesting what's happening with in the banking industry. Like you will have your account, you'll own your account. The bank won't own your account.
Right.
And you'll take your account from bank to bank to use their services.
Yeah, so they'll have to come up with something better than just put your money here.
That's right. Yeah. They're going to lose balances because people are going to own that. Right now, what are they going to own? They're going to own a CBDC, which, I mean, my opinion, you got to avoid those like the plague, right? Because that's basically the Gestapo in your pocket, right?
Yeah, it's not like Bitcoin. Different.
It's not like Bitcoin to the extent that the government now can tax you real time. They can seize real time. They can freeze real time. So CBDCs, I think are it's the devil in your pocket. So I would avoid those like the plague. But everything will be in your pocket. It'll be all digital, and you will own it.
Yeah.
Right. You'll own your key, and you'll own all that stuff. Now, what's the bank going to do? And the banks are already starting to think about this. How are they going to pivot
because
to
they
provide
have to
service?
have these deposits to create their fractional lending.
Yeah. Right.
So what are they going to do if these deposits go away?
Yeah.
We're
all just making this stuff up as we speak, right? I mean, it's we're watching the sausage.
It's disruption.
Yeah. Yeah. So it's
true disruption.
Yeah, it's pretty amazing. So it's going to rapidly change over the next decade.
All right, we're back. So I was just in Copenhagen, and then I went across the bridge to Sweden, and they use the euro, I think, in Sweden. It's different.
Yeah.
It's not the Danish, whatever it is.
Yeah, they're all part of the EU now.
Yeah, it's in the EU. So the U.S. was pretty much neck and neck with the euro, right? So the dollar. What? How do you think that we're stacking up? We're kind of in our own little bubble, our own little world, seeing the inflation, seeing like the problems we have in America right now. But I'm pretty sure it's a global thing. There's global problems. There's global inflation. Other countries are seeing a lot of inflation because I think the World Banks or whoever did it, was sending out money to everyone in COVID, right? So like a lot of countries printed tons of money, and so I guess my question is, where do you think we stack up is in the U.S. against the rest of the world, Europe?
Well, I think you made a lot of good points, and observations, which is at the end of the day, we don't do things in isolation, right? We have our G20. They all meet, regularly in Davos, right?
Right.
They get together and they say, right, what are you doing? What am I doing? Yeah. And so, you just can't do things in isolation because you're stepping on your buddy's pecker, right? I mean, it's you can't. So they're all doing it in concert,
right?
So if you look at the M1 money supply of all these countries, they're all kind of eerily similar.
Yeah,
they're
right? All in debt, tons of debt.
Yeah, and then they're printing the hell out of money.
Yeah.
So inflation is going to be similar everywhere. So what's the purchasing power parity between all these countries? I mean, they're all kind of moving around, but they're all kind of.
But they're all kind of in a bad place.
They're all
not just U.S. that's
right.
hitting this crazy 9% inflation.
But where are the emerging countries that did not buy into all that? Right. What are they doing?
Are they must be strengthening, right?
You would think, if they're not printing, because if you don't print, right, you don't have inflation,
right?
Generally speaking, right? I mean, inflation is the byproduct of government printing of money.
Unless you're in a country where the rich come and they're spending more money in your country for some reason, but that's probably good for your GDP, right? Yeah. Tourism, and so you think it's not just a U.S. problem; it's a global problem. With this inflation thing,
it's a global problem for any countries that use monetary policy to, basically pay people to stay home.
Right.
Right. Yeah.
Wow. Was that that feels like it was an experiment or something, man?
It's an experiment. It's interesting. I mean, if you look at the M1 money supply, it's quite alarming.
Yeah.
And you don't see it on the news. I don't know why not. It's like, you see, Powell and Yellen in front of the Senate saying, inflation we think is transitory. I think it's dishonest. Yeah. They're not dumb. They can look at them on money
brush
supply.
It under the rug once people find out. They're like, well, we were wrong, but no big deal.
Yeah. And maybe I'll change the CPI a little bit so that it doesn't look as bad, right? Because they do that also every year. They change the CPI, and and the justification is, how they measure CPI, and the justification is, for instance, like, your TV used to be $50, now it's $1,000, but your TV does a lot more. So, we're going to adjust that,
Yeah,
but,
the phone's not a phone anymore. It's
Yeah.
a computer.
But I don't feel 9% when I go to the grocery store or when I go to the gas, right? Or when it comes to affordability. To me, it feels a little bit more like 30%.
Yeah,
But,
it's crazy.
I think everybody else is feeling the same thing. So it's just dishonest, right? But they don't want to see 30%, right? They can't share 30% with the
Can you
population.
imagine what would happen if they were like, oh, it's actually 30%?
Yeah, it'd be riots.
Because gas went up
Yeah.
40%, whatever
Yeah.
it was, 50,
Right.
40.
Yeah. So
Houses,
it's
40% in a
Right.
lot of ways,
Yeah. It's really sad because it's going to affect the low income and middle class the most, right?
Yep.
And the
Yep.
people that make the most money during hyperinflation are the wealthy, right? Because
Totally.
they're able to pick up assets, they have assets, and their wealth is just going to get more because they own stuff that appreciates, right?
And they own the businesses, the big
Yeah.
businesses that
Right.
all the poor and middle class are
Right.
using that cash to buy
Yeah.
stuff, and they're,
Right.
it's just, it's
Yeah.
on and on.
So
So, our podcast is geared towards mortgage professionals,
Mm-hmm.
mortgage brokers, realtors, people that, are interested in knowing more about, mortgages and things like that. So, one of the questions, what would you do if you were a mortgage broker to drum up business right now?
I'd pivot into or diversify into alternative lending.
Yeah.
Right. That's
'Cause
what
people
I'd have more
always-
products.
People always need to borrow money.
They always need to borrow money. So I pivot into other products. I mean, it's this it's the balance between focus, which makes you really efficient, and diversification, which makes you inefficient, right?
Yep.
Because if you're just doing residential mortgages, purchase finance, right, you can get really, really good at that.
Right.
But then when that dries up, you're kind of screwed.
Yep.
So you kind of have to, you got to try to have a
Diversify.
bigger quiver.
Yeah,
of
so
stuff
like
to do.
private money, like
Yeah,
what
private
was-
money. Private money, obviously, that's something, going back to you saying how, the conferences that I've been at, right? I mean, the one thing that I'm noticing when I go to these conferences is that, as a private lender, we're sexy again,
Yeah.
right? I mean, there was, for several years, right? I mean, Wall Street was eating our lunch because they're, just like they did during the financial crisis, right? So,
Well,
they
when
start.
private money has to go down to like 6% interest rates,
Yeah,
it's not sexy.
It's not sexy. And so as a result, you just kind of slow down on your lending and you just,
Yeah.
you pick your opportunities.
Right.
But, and also, inflation at 9 and you're lending at 6 or 7 or 8. I mean, that the private money also is not as efficient as Wall Street, so it takes a while for the private lenders to adjust
Yeah.
their pricing.
Yeah, because
so-
I see that now. I mean, with Fidelis and with probably with you guys, like the command for the lower rates is still there, and there are people still giving those lower rates.
Yeah.
So like private money and like say maybe non-QM have kind of come to this kind of weird, almost
Yeah.
parity, and they're
It's strange.
yeah,
it's
it's
a strange
strange.
time.
Like
yeah.
8.5% for a first mortgage. Like I can
Right.
go get a private loan for that, and you're like,
Right.
well, yeah, it's a balloon. It's 1 year
Right.
balloon, or it's a, it's not the same. You got 3 points on it or 2
Yeah.
points on it, but you see private money going up. Have you
Yeah.
been seeing that? Like what?
Yeah,
what-
yeah, definitely. I'm seeing, where, you see you're competing with people that are putting out 7 and 8s, right? Which,
Yep.
is now you're hearing 9 to 12, right? You're hearing people start to demand, the double digits.
Yep.
That's happening. But you're kind of proving my point, right? QM and private money are kind of merging right now because QM is way more sensitive,
Oh, yeah,
because it's
instant,
an efficient market, generally speaking, right? And private money is not, right? The private lenders will start to adjust when they see that like their investors are not interested in a 7 or 8%
Yeah.
anymore, right? Because if they're looking at 9 inflation, like, why you're not even getting me inflation?
Yeah, it's
I don't-
breaking even.
Yeah, I'm underwater, right? I mean, when they're seeing, so yeah, your real return is less, right? So you have
Right.
to at least beat inflation, which if they're claiming it's 9 right now, which I think it's a lot more, but even if it's 9, you should be a little bit more than that. At least, get a point on your money, at least be 10.
Yeah, right. But the people that are sitting on the sidelines with cash, they're just losing. I mean, it's the risk versus reward thing, right? They're just like, well, shit, it's a big risk
Yeah.
for me to put my money to deploy it. Like, So I'm just going to leave it there and lose 9% on it.
Yeah. So that's, and I think, and we feel that, right? Because it's our money, like
Yeah.
we're putting out. So it's, do you leave it in the bank? You're definitely losing money. I mean, like I said, your purchasing power has gone down 30%, right? So, my eggs used to be 4, now they're 8, right? My gas was 3, now it's 6. But your purchasing power is going down. So then it's a question of how do you loan the money out, right? There is a point where, okay, well, I'm not going to do a, 80% LTV loan. I'm going to do 40 or 50. Right. Now, does the market want 40 or 50? I mean,
we'll see.
When nobody's lending, so then it's competition, right? Where does everybody want to be in terms of LTV? So private money lenders will adjust their risk based on LTV.
Are you seeing the LTVs drop because they're afraid maybe the values will drop?
Yeah, that's happening.
So private lenders that may have gone 80 LTV or 75 are saying, nope, I'm going 70, 65.
Yeah, that's definitely happening. Yeah, or they're just, I'm also seeing a lot of alligator arms, like at the conferences, people are still out there pretending to lend and then they're not lending.
Yeah,
right.
It's either raise their rates so hard, make it so difficult that
and partly is because they want to remain relevant. They're not going to come out and say I'm not lending anymore because then the spigot. They want to continue to pretend because they're hopeful that at some point there's a landing.
Yeah,
right.
And then it's safe again.
And then everybody gets back out. So.
Everyone feels the warm fuzzies and
the warm fuzzies.
All right, so you've been around like we talked about earlier that seen some cycles, seen some crashes, and stuff comes out of nowhere and you don't really know like what to expect. No one really has a crystal ball. Like, what would be your advice for your average mortgage broker right now?
Well, diversify. Yeah, other products. I mean, I guess depends on the profile of the person, right? I mean, I think get ready for some, some difficulties for sure.
Yep.
And then also, we hope that maybe there's opportunities in distress coming, right? So, we're all going to have to, band together and be the cleanup crew, right?
Yeah.
So,
and that's
what happened.
Where do you think the distress? Where's the weakening right now? Like, where's the distressed weakenings? Because, like we talked about earlier, a lot of people have equity. A lot of people, I think one of the areas that I would say, and you can comment on this, is a bunch of people bought second homes because things were great. Everything was great, and they buy them sight unseen. They, ski areas.
Havasu. So I sat with a guy at lunch from Havasu, nice guy. He's a builder. Property values are down 10%.
Okay.
That's just the beginning, right? I mean, during the financial crisis, it was interesting, right? You had all these areas, these booming areas. The second homes are the first to go, right? Yep. And then all the the new luxury homes, right? So Cielo, Shady Canyon, Paradise Valley, Scottsdale, Phoenix. I mean, we could name a whole bunch. Eerily similar, right?
Right.
Lots of inventory.
Golf communities. They're in areas that people don't live in. They're second homes, and they're not necessarily Airbnb.
Right.
Homes. They're like Arizona. Like, I would never go to Arizona for vacation. And that's, I'm not saying that as a negative thing. I'm just saying, like, I live in San Diego. Unless I was going to like a golf open or whatever. Yeah. Like, I'm not going to Arizona for anything other than business. But some people would go from like Utah, Idaho. They come down to golf in Arizona. Great weather, right? Yeah. But when you're a California person, you probably won't do that. So like areas like that, you think will get cut pretty deep?
Well, I think it's the areas that are extremely volatile, right? So those places where prices went up fast can go down faster. Yeah. Right. So, and I think that lesson has been learned. I mean, maybe not been learned, but we've seen it, right, historically. So, and also if you're a chartist, it's always interesting, to look at the charts, right? How fast have we gone up, right? And if you kind of do like linear regression and go, what's an average growth rate, right? And then you take off all that froth, it's a big pullback, right? And if you also look at the economy from, the last financial crisis, they wouldn't let us fail. Every time there's a little blip, there is more money pumped in. Every time there's a little blip. So it's interesting to look at the charts.
Back then it was a B in front of it. Yeah. Now it's the T.
Yeah. It's kind of alarming. So, and And then also, look at migration patterns too, right? So
people left to California.
Yeah,
people
where are they
left New
going?
York.
They're going to Texas, they're going to Florida, they're going to Idaho, they're going to Nevada,
Yep.
right? They're going to Georgia, they're going to
Tennessee.
Mm-hmm. So these places are they're maybe less volatile than others.
Yeah.
So finding those places that are less volatile,
unless they just started building like crazy.
Yeah,
and if
right.
there's a lot of inventory, they just got caught kind of
Right.
musical chairs.
Yeah.
But yeah, I mean, I think hopefully people saved some money. Last year was a boom,
Right.
banner year, right?
Yeah.
Great year,
Right.
So a lot of people made some investments, hopefully, and some good stuff, and
wait.
wait.
Don't go in too quickly. Right, it's gotta wait a little bit. I mean,
Be
nobody's
patient.
gonna ring the bell when it hits the bottom.
No,
right? Like they
no.
won't ring the bell when it hits the top. But
do you think that the Fed and the kind of like to your point where you said earlier that these they didn't let us fail, right? They just kept pumping money.
Right.
They're not going to stop pumping money, right? They're going to keep raising rates, but then they're going to do like, okay, here's some more stimulus, here's some more of this,
like a
more of
$10,000 check for your college forgiveness.
for your college forgiveness, right?
Like
They're
stuff
gonna-
like that.
They're going to continue to do that, and then of course they're going to bail out their buddies, any
Yeah.
banks or any other,
Right.
So like
There's
Where's
a
the
limit.
distress?
There's a limit to that, right? So
Yeah.
I mean, you have to have. There has not been an economy where there were limits to spending and printing money.
yeah.
So Venezuela, right? Okay,
Argentina.
Yeah, Argentina. I mean, you used to go back in history. Basically, every currency has failed.
Right.
I mean, right? I mean, every currency fails eventually, but there's a limit. And so I don't, like what Volcker did back in the 80s, right? He had to slam on the brakes. He had the testicular fortitude to go, we're not going in the right direction, and he just slammed on the brakes and created austerity. It was painful for a hot minute, but then we got back on track.
Yep.
Do we have that fortitude today? Now, I don't think we do, right? So we're kicking the can.
Yep.
And then, is it going to get worse? Is it going to be, and how do you manage that risk?
Yep.
Right? Because you have to have austerity.
Yep.
So,
Well, we got midterms coming up.
yeah, we got midterms coming up.
So I was watching something the other day that said, on average, if you look at presidential cycles, you'd see the down market is typically in Q2, second year,
Yeah.
first, second, third quarter, fourth quarter. Second year is pretty bad in a presidential cycle usually. And then after the midterms, it sort of picks up again for about a year-ish.
Yeah.
And then election year, all
Right.
bets are off.
Yeah.
And so some of the prediction was, after the midterms, we're going to see an uptick. In
Right.
Not uptick in like anything bad, just like an uptick in like good things. So sort of like, the stock market would be good, or
If we're okay with more inflation, then they'll continue to do quantitative easing. We're still in quantitative easing,
yeah, which is
relatively speaking.
right.
The rates aren't that high.
Yeah.
They're higher, but they're not that high.
I mean,
and they're not higher than
still
inflation.
In the twos, right? For the Fed's in the twos. They're 2.5.
My mortgage, 20 plus years ago was 7%.
Right.
I mean, so
Yeah, when I got in
that's
the biz-
probably, I would argue that that's normal, right?
Right.
2-3% is not normal.
That's not normal.
Yeah.
So those people who have those rates,
It's an asset.
They don't want to touch it. That's like
No.
gold.
Well, that's what I was saying, 3 years ago, which is, that was the time to borrow as much money as you possibly can,
Yep.
right? Because it's free.
Right. That's
Right?
why, I mean, I went and bought a few
It's free money.
properties. I was like,
Yeah.
I'm gonna get these low rates,
Right.
and then you're gonna have an asset for forever.
Yeah.
Get a 30-year fix.
Right. 100%.
So people, I think a lot of people don't want to get rid of that, but then they don't know how to manage. Like, what do I do to get this equity? What do I do to
Yeah.
So I've heard rumblings of people talking about trading homes and stuff like that.
Yeah. Yeah. So some creative products, right? Wrap mortgages might become in vogue
Wrap,
again.
yeah.
Right.
What's that like for the audience? What does that mean?
So that's when you keep your mortgage that you have now, and then somebody else gives you another loan, right? And you're paying on the bigger loan, right?
Right.
And then they're collecting on the smaller loan,
Got it. Yeah.
right? So you don't have to get rid of that loan. It's kind of like a second, but it's one mortgage you pay.
Interesting.
those wrap mortgages.
Yeah.
Those might become in vogue.
I might need to look into that.
Yeah.
Interesting.
Yeah.
What's inspiring you right now with all the negative news? Like, what's actually inspiring you?
Tequila and blockchain.
Nice.
Yeah.
Yeah, you do have a tequila interest.
Yeah, I have a tequila interest.
It's a good spirit.
Yeah, it's a fantastic spirit.
Keeps things not.
Mezcal actually is I think my subcategory of the tequila, of the agave spirits.
Right.
Yeah, I'm loving the mezcal.
That's good.
Yeah.
It's fun. I'm enjoying it too. What about any shout outs to anyone that's kind of helped you along the way? Someone who's been there for you, someone who's inspired you, someone who's been a mentor, anyone you can think of?
Well, I'd be in trouble if I didn't mention my wife,
Shout out to Jessica.
Definitely grandparents. I had some cool grandparents that were inspirational, right? My dad's dad was an undertaker and very much an investor in the stock market, right? So, he from an early age, he would always send me articles to read from the Wall Street Journal.
Okay.
And then he would send me $20 also. And
so
then
here's money. Now read this.
Yeah. And then he would call me and go, so what'd you think about that article? So I was smart enough to know if I didn't read the article that I probably wouldn't get another $20 next time. So I was reading a lot of articles.
That's cool that he invested in you like that.
Yeah.
Because that most kids wouldn't be reading articles like that.
Right. So I've had some good influences. My mom's dad was a builder back in the day, right? Built a lot of Chula Vista, Arizona, Texas, Nevada, and then my wife's dad, my father-in-law, is a big influence, right? He introduced me to the loan business.
Nice.
Right. Yeah. So, yeah.
Very cool.
Yeah.
So, if our listeners want to connect with you, where would they go? Like, to your private money company and.
Yeah, but there's always helveticagroup.com.
Okay.
They
can invest in that, or they can potentially.
There's Raisley.com, right? So
Yep.
we have Raisley.com.
How do you spell that?
That's raise, like raise money. It's raiseli.com. So that's our platform.
Right.
That's not very public. It's available publicly, but we're not
you can
marketing
invest in notes and
yeah.
potential
Yeah,
deals.
yeah. You can even just go in there and peruse and see what kind of deals are happening, just to just to be interested, right?
Yep, for sure.
To peruse. And then there's our investment bank, which is helveticagroup.com.
Awesome. Well, thanks for coming on, man.
Thanks for having me.
It's been great.
Yeah, it's awesome.
All right, well, guys, please like, share, subscribe, and let us know if you have any ideas for guests. And we're here to help you guys get more business. Thanks for watching. See you on the next one.